Okay guys, I'm Ed in Bordeaux, and so I've chosen to do my video on the ethics found in Appendix B. I'll begin with the principles, which are, according to the IMA, honesty, fairness, objectivity, and responsibility. Why is this important? Why do accountants care? Well, without honesty, accounting can hurt a lot of people. Looking back to the Enron scandal, they used dishonest accounting in order to allow them to hide humongous amounts of debt from the public, debt that reached into the billions of dollars. This not only brought the company and all people involved with it down, but defrauded investors and caused a pretty big impact to the financial markets. Fairness and objectivity go hand in hand, and the reasoning behind these two principles is that no matter the client, big or small, the accounting is done the same way to the same standards. This helps to ensure that what is being reported to both business owners and the public is a report that won't try to make the company look good for the owners or investors, and that even if the accountant has a stake in the company, that it still receives the same treatment as any other business. The last principle is responsibility. When an accountant is tasked with creating reports for a company, they have to be on top of everything, from making sure all receipts and invoices are together to managing data in an organized fashion. The accountant has to make sure that they will provide accurate and timely reports as needed. Next is the standard of ethics. These are competence, confidentiality, integrity, and credibility. The accountant must be competent. This means more than just having knowledge of what their accounting duties are. It means that they must be able to recognize errors in their work or others, know the laws of the state, county, and city they are in, and knowing what they can and can't do as accountants. Confidentiality is also key. An accountant can't go around telling people the financial situation of the company when it is not their place to, especially in managerial accounting. Keeping a client or employer's finances private is important, as it gives the client or employer the power to release their financial reports only when necessary. In addition, the accountant can't use their knowledge of a financial statement to give themselves or others an advantage. For example, an accountant cannot use a company financial report they are working on to tell others to sell stock, as this is insider trading. Integrity sets apart companies like Enron from companies that are still in business. Accountants cannot fudge the numbers, hide data about performance, or otherwise create a situation in which the company is unfairly represented, whether it be to evade taxes by underreporting income and overreporting costs, or to encourage investment by overreporting performance. Accountants must also seek to report any violations of law to either management or, failing that, to the proper outside authorities. Finally, there's credibility. An accountant must keep on top of their work and perform unbiased reporting with respect to their work. An accountant must not let red flags linger, whether they be violations of law or issues that could make a report less than accurate, such as missing details in prior journal entries. When ethical conflicts arise, there is a three-step method to resolve the conflict outlined in the Code of Ethics. In our example, let's use a case of a production manager who over-reported production costs in order to pocket more money for himself. The first step in the process is to speak with the supervisor, unless they are the one suspected of committing the unethical act, in which case you would escalate the issue to the next highest level. In this case, the first person to talk to would be the head of the accounting department. If the head of the department brushes it off, the next step would be to go to the head of production, then to owners, officers, and board members. The second step is to contact a member of the IMA Ethics Council to set up a confidential discussion of the ethics violations taking place. This gives a better understanding of the issues at hand and can set you on the right course into resolving the issue. The third and final step is to contact your own lawyer with questions as to how to proceed, including your legal obligations to report the conduct if the issue is not resolved at an internal level. Such oversight could have been useful during the Enron scandal. So that's what I have to say about Appendix B, and I will now be ending my video. Thanks for watching.